Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, wishing you all a happy, healthy, and prosperous 2019. And I'm speaking to you from New York City here on the 8th day of January, 2019. As always, I do like to remind you that I'm the editor of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe to that letter by going to miningstocks.com, and quite frankly, I'm very optimistic about the kinds of items, the recommendations that are made in my newsletter for this year. I think the things are lining up very positively for gold, and we'll hear from some of our guests today. I think, in fact, all three of them are likely to agree with me on that score. We'll hear from Michael Oliver in a minute or two about that. We do want to encourage you to keep your questions, comments, criticisms, comments of any kind. Keep them coming along to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com. And, of course, we do want to thank our sponsors for making this show possible, for making it economically viable. Sponsors for today's show are RN Resources, Novo Resources, Triumph Gold, Gold Mining Inc., Uranium Energy, and Klondike Gold Corp. I've titled today's show, The Everything Bubble is Starting to Implode. Alistair McLeod, Chen Lin, and Michael Oliver, my guests today. As the late 2018 stock market decline morphs into a far more serious event than the 2008 financial crisis, at least that's the opinion of many, you will hear mainstream financial anchors declaring that no one could have seen this coming. Well, that would have been fake news, because Alistair McLeod told our listeners in August that a decline was inevitable and that it would start between the fourth quarter of 2018 and mid-2019. In the second half of today's show, Alistair will explain why this meltdown was predictable and why it is most likely not yet nearly over. We will also ask him what he suggests we do to help protect our wealth from the financial destruction that most likely lies ahead in this, what many people are calling the everything bubble. Right after our first commercial break, Chen Lin will be with me to share his vision of 2019, as well as taking into account his insights that come from his close connections in China. His family lives there, and he has many close friends in China. They provide a sense of what is happening in China from what you might not necessarily hear in the mainstream media here. And so I really look forward to hearing what Chen has to say about his top picks for 2019, and he'll be with me after our first commercial break. Now today, when the equity market is bouncing back, we've had a few days now of bounce back after some pretty significant declines. I'm really pleased to have Michael Oliver with me again, and Michael, especially after missing him over the past 2 weeks, it's really great to have him with me again today. Thanks for joining me, Michael.
Good to be back, Jay. Great.
It's good to be back, and it's always good to tell people that your website is olivermsa.com, olivermsa.com, and it's good to tell people that because you have a special offer for people that are interested primarily in gold and silver and the precious metals, and it's a much less expensive service, a very affordable service, and I hope people will at least go there and check it out. Michael, the equity market definitely is, it seems as though Chairman Powell sort of offered some dovish commentary recently. President Trump's been putting a lot of pressure on him to try to keep him from raising interest rates. And then when the equity markets tank or get hit really hard, that really seems to be put the pressure on whoever the Federal Reserve Chairman is. It seems to me that Chairman Powell understands that we need to get back to letting the markets decide interest rates. That's really hard to do, it seems. But in any event, based on your momentum and structure analysis, whatever the politics may be, are you buying the notion that the equity bear market is over, which is what it seems as though the mainstream media would like us to believe?
The bear market just began. The top is in place. These kind of rallies that we're having now are typical of arduous tops. By arduous, I mean laborious, where they fool you for 6-9 months, even after making the peak of the bull market, before it becomes apparent to the public and analysts alike that, oh, it really is down. Go back and look at the 2000 top, the 2007-8 top. I mean, it was 9 months or so after the peak before it ever became obvious, and even then it wasn't obvious to everybody, to most viewers that it was topped. We're doing the same kind of thing now, and we stopped precisely where MSA had argued that the next drop would take it, namely blow out the February low. S&P low was either side of 2550, and we'd go to 2400 or slightly below. Well, we did one at the 2300s. And we have a rally now. That rally marked the spot that we thought was the most lethal place. It had to stop at it, but it's not that it saved itself. It stepped on a landmine. It should not really have gone there in the first place. What it is on annual momentum, we have returned to the same momentum levels that we did at the 2011 bottom. Remember the European debt crisis, which was a correction within the bull trend. And the 2016 low, we just matched them on the oscillator. And when momentum sets a triple bottom, it rarely ever holds it. So that recent low, we went down and touched what for momentum is a triple bottom. And we think it's going to implode. The question is, can they keep the rally together for a month or so, in order to stay off the low for a month or two? Or is this another one of those 2-week flares? If you go back and look since October, there have been repeated 1- and 2-week sharp rallies that just disappear after a while. And is that what we're doing now, or is this going to be a little more protracted? I can't answer the question, but I can say that the top is in place. We're going down. I think gold is going up. And again, we reiterate our point we made in early December. I thought in 50 trading days, gold would be above 5 years' worth of highs, which is to say taking out the upper 1300s. So far, we've reached 1300. And we're only about 20 trading days into our prediction, so we'll see. But I think that's the other side of the coin.
Yeah, you said 50 trading days. I think you were looking at something along 1350 as being a very significant resistance level. Do I have that right? That's
a level that's been tapped too many times. A child with a crayon could draw a line across a monthly gold price chart going back to 2013, let's say. Every rally high from 2014, 15, 16, 17, and 18 line up with a gradual downtrend line across them. It's almost flat, but it's slightly declining. 1350 now, you're hitting the line again. And we argue that you ever get even anywhere near that price line, you're just going to blow right through it. And we think there's enough momentum evidence in play already, regardless of that price level, that price level will in fact now be attacked, and quickly. So, anyway, that's our bet.
So if we get through 1350, is it a whoosh sort of a
I think it's a whoosh effect. Yeah, in fact, I think getting there will be a whoosh effect. So far, it's been an arm wrestling rally in gold since the August low. There was each month is up, but it's not. There's no explosion in this. It's just arm wrestling. They fight you all the way. You get bad sell-offs here and there, but it goes and makes a new high each time. I think there's a tipping point, and I think we're in that zone already, that the last effort to keep this thing incremental was that selling at 1,300 earlier this week. I think if you go through that, you'll probably zap through the 1,350 rapidly.
And then where?
Well, the swing measurement using price charts, using orthodox methodology of price charts, which we don't usually do, but I tip my hat to them occasionally. It says the next leg in gold goes to 1,700. Well, I can argue you're not going to stop there, but that's the first swing objective after you come up out of this price base. Out
of 1,350.
I think 1,350. Our next swing objective would be to 1,700. Maybe there's some, anyway, but that's enough in itself. But of course, you're not going to stop there. We're in the mega bull trend of gold. I think in its since 1975 when it became legalized. I think this is the bull market in gold that will take it off the page, because I think the world is going to change. Monetary game playing is over.
So when you're talking about long-term bull market, you're really talking long-term bull market here. We're talking about
it goes high enough to where it maybe becomes part of foreign exchange again, where many world currencies are backed by gold. I think the game playing of monetary game playing is since Nixon took us off the gold standard international exchange. It's been deuces wild since then, and I think there's enough people in the world, even in government, who realize that this has not worked. Yeah. And that there's only one sane alternative, and that is to back your currency by something like gold.
Well, certainly the Chinese, the Russians, various adversarial nations to the U.S. are starting to do that, so it seems, certainly building up their gold reserves dramatically. That would be some kind of a move, Michael. And if it happens this year, you think, or we get?
I think a good portion of this will happen rapidly. I don't think this is a protracted multi-year thing. I think that the chaos theory enters into it here. Incrementalism plays up to a point, and then I think we're facing a crisis in many markets. It's reflected in many markets, whether they're going up or they're going down because of the crisis. That speed will be a factor this time.
Yeah. Well, the system breaks down, and then you get chaos. But so, I mean, in terms of, what is an ounce of gold? It remains the same. The dollar is what isn't fixed. The dollar,
yes.
That is the key. So, if you're talking about something like that in gold, I would have to think the existing currencies then would be coming under a tremendous amount of pressure, and the dollar being king might be the one that's in the biggest.
I think that's what's going on. And gold is, if you'll notice, most commodities. Well, now the food commodities are starting to assert themselves, but oil and copper, for example, have been bashed very badly this past 6 months or so, several months or so. They had a big gain in 2016, but they've given a lot of that back. But it's not really a commodity uprising yet. But why is therefore gold and silver advancing? Why is gold advancing so strongly? If we don't have commodity price inflation, which is the way most people define inflation, it's advancing because it's a monetary issue.
Right. No, I couldn't agree with you more. And I'm wondering, just my engineer's telling me we're out of time already, but I do have to ask you, the gold stocks looking strong? Do you now?
Yep. I like the gold stocks better than gold.
And, well, one question I have to ask you, Michael, because I'm going to ask each of my guests today, is next year at this time, equity markets higher or lower than they are today?
Vastly lower.
Vastly lower, not just marginally lower, vastly
lower. Not just lower, okay. Mm-hmm.
Okay, all right. You won't give me a precise number, I suppose, and that's okay.
No, I won't, because it's too dark to talk about. Okay.
All right, well, I don't know if we want to laugh about that.
We live in big times. We live in big times, okay.
Yeah, I think you're right, and it's it causes a certain amount of anxiety, I must say, and yours truly. I do worry about a lot of the things that are transpiring, but in any event, Michael, thank you very much for your time and offering your thoughts. Not only your thoughts, but your thoughts are based on the numbers that and your own proprietary methods that you have devised over the years. And I've just found them to be so accurate and so helpful to me. So that's why I'm really glad that you can be with us. All the best to you, Michael, and I hope we can talk to you again next week.